We have before us the opportunity to forge for ourselves and for future generations a new world order.
This is Multipolarity, charting the rise of the new multipolar world order.
Hello, and welcome to Multipolarity, the podcast. It's interesting times out there. We took a bit of a break for the summer and uploaded a 3-part series with Malcolm Cheyenne and Americanets, which I thought was very good, but usually in August things calm down a little. It's known in the media world as silly season, where you kind of report on slightly silly stories because nothing's happening, monkeys making friends with each other, strange creatures in the Midwest of America, maybe a Bigfoot sighting or two. But this August has been very different. It's probably been one of the most eventful Augusts in living memory. As the markets went into a kind of a sleepy period, it appears that the beginning of a serious crisis in the US dollar global system has started. It probably started before August, but it started to become manifest in August around the bailout of Japan by the United States. Listeners will probably have seen this about 3 weeks ago. The US Treasury had to intervene in the market for Japanese yen. The yen has been in freefall for years now. It seems to have absolutely no bottom. There are strong structural pressures on it. It's due to the low interest rates that Japan runs. This results in what's called the carry trade, where investors borrow money in yen at low interest rates and invest it into higher interest currencies. Those can be standard Western currencies like the United States dollar, the euro even, although the euro wouldn't be a great carry trade right now, but you could reinvest into the US bonds, or the other trick is to invest it in fairly relatively stable EM markets. Mexico is a pretty popular carry trade. The Japanese yen to peso carry trade has made a lot of money in the last year or two. These carry trades, if done properly, can produce returns well above standard market returns in the S&P. So they're very attractive. But of course, they involve effectively taking a short position in the yen, and so this puts continued downward pressure on the yen. Well, why wouldn't the Japanese central bank just simply raise interest rates and cut off the carry trade and stabilize the yen? The reason is they can't. They have zombie companies. They're called zombie companies. They make up about 10 to 15%, sometimes 20% in some years of the Japanese economy. These are companies that just survive on bank credit. In fact, they require borrowing just to pay down the interest on the debt that they already owe. The economist Hyman Minsky called this a form of Ponzi borrowing. He said it was the beginning of the end of a financial cycle or a financial bubble, when you see companies start to crop up in your economy where they're borrowing to repay the interest on loans, what he calls Ponzi borrowing. You're one step away from a major financial crisis and recession. The Japanese have staved off this crisis for years through their low interest rate policy and easy money policies. So these companies can exist. They don't generate enough revenue or profit to pay off the interest, and they continue borrowing. But of course, if they make up between 10 and 20% of the businesses, if they ever went under, Japan would have a major recession, because effectively, 10 to 20% of GDP would be at risk, 10 to 20% of employment would be at risk, and the economy would just crumble. It would have a major crisis, which would have knock-on effects, of course. So it can't raise interest rates. I mean, interest rates on the 10-year Japanese bond are going up, but they're currently still significantly lower than American interest rates, for example. So they're stuck on the interest rate policy. They kind of need to raise those rates, but they can't. They're in a trap. And so the alternative is to prop up the yen by selling their reserve assets, which of course are held in dollars and US Treasuries. But if they sell the reserve assets, they create crisis in the American bond market, because they'll be flooding the international markets with bonds. Japan is the largest holder of US dollar bonds in the world. The second largest holder is the United Kingdom, which we'll get to later. So Besent realized this, the Treasury Secretary Scott Besent realized this, and he stepped into the market. And what he basically did, his initial intervention was to short euro and buy yen. He clearly here was hoping to not send a negative signal on the dollar because he's very worried about the dollar financial system. So he took some euros that were on hand at the Treasury and bought yen with them. The Europeans were incredibly mad at this. The kind of unwritten rule of foreign exchange interventions by state actors is basically don't involve anyone else in your crisis. Europe has no problem with Japan. It doesn't rely on it in any way. It has nothing to do with the situation. And when Besant comes in and shorts euro and buys yen, he's pulling Europe into their problem. And that was viewed very negatively. It was met with what I think was a response by the European Central Bank, which basically gave guidance to start dumping AI stocks. If Besant picks a fight with the Europeans, he'll soon realize that Europe is an incredibly important creditor to the United States. When I say that Japan and the United Kingdom are the largest holders of US debt, this is true on a country-by-country basis. Europe as a whole is, I haven't checked, but I'm guessing it's by far the largest creditor to the United States because it makes up 27 countries. Many of these are big countries that run large trade deficits with the United States. And of course, you can even argue that the UK to some extent is Europe, although it is certainly a separate case because it has its own currency. So that was the first intervention. The second intervention by Besant was to open up a very strange mechanism by which basically the Japanese were allowed to sell the debt, but they sold it to the United States. They sold it to the US Treasury. That was never really going to work because that's effectively just monetizing the debt and turning it into domestic monetized debt. Besant's intervention in the yen market didn't even last a few days. It was a complete failure and the yen continued to fall, so the crisis continues. That was the first intervention. We then actually ended up getting data that showed that the United Kingdom and Japan have been selling down this UK government, this American government debt since at least June. There's a crisis brewing in these economies. Japan's, I've already explained, it's this doom loop trap where they're trapped in this carry trade. By the way, why can't they let the yen depreciate? We should probably address that. Because almost 100% of Japan's energy needs, apart from their nuclear and renewables, come from imports. And as the yen falls, the import price on those energy goods, which is the main good, it's the main primary good in your economy, rise, and inflation rises. And people get squeezed and their living standards get squeezed down as the price of energy products rises because the yen depreciates. So they're completely stuck on that front too. Japan's in a huge crisis. It's in a generational crisis. In fact, its entire geopolitical and financial model is about to collapse. Meanwhile, it's elected a highly unstable prime minister who was in the news this week in the Telegraph the day before recording, saying that she was so lonely she'd made friends with a cockroach. She was talking to the cockroach and she was convinced it had something to do with reincarnation. So I said it when Takaichi was elected. I thought she was a highly unstable person. I don't think she's in any way suited to be a prime minister. And I think she was basically backed by the anti-Chinese faction in Japan, which has strong links to the United States. Increasingly, this kind of geopolitical bet is turning out to be a very bad one. And in general, I think we're seeing all over the world, Hungary, for example, we've already seen it in Ukraine, preying on these emotionally unstable people, turning them into ultra vassals by promoting mentally unstable people. It's not a good strategy. And in fact, it's not, the people doing it may think it's some sort of a strategy, but when you take a bird's eye view of it, it's just imperial collapse. This is the classic decadence that you see at the end of empire, Nero electing his horse to the Senate or something. Like we often see those instances in history and we don't understand why they happen. Why would things get that crazy? Well, the Japanese prime minister is talking to a cockroach while the country falls into a polycrisis. So, we're at the end of something here. So that was the first failed intervention. The latest one is last week. Scott Besent seemed to lose control over the treasury market. He tried to engage in what was effectively an Operation Twist thing. He was selling short-term bonds and buying long-term bonds in the hope that he could drive down the interest rate in the long-term bonds. He was trying to twist the yield curve, as they say. The main problem with this is that's not the Treasury's job. Yield curve control, to the extent that it's anyone's job, is the Federal Reserve's job. The Federal Reserve sets interest rates. The Federal Reserve does not want to bring in
Andy Collingwood here to say that you have reached the paywall. A paywall is like a real wall, except it's you buying access to our premium content. We do 3 free shows every month. Then, to keep the lights on, we ask our fans to pay for the 4th. Just go to patreon.com, enter a few quick details, pay the currency units, get the episode, become part of secret multipolarity. But these days, you can also sign up on Substack. There, you get the premium podcast, plus any written work that we add to Substack. The choice is yours. Of course, if you're already a member of the club, the show continues just beyond this point. If not, for now, goodbye.
When one of the houses of government, either the Congress or the Senate, they can bring in FOMC board members and grill them on why they're lowering rates or buying US Treasury bonds when they expect inflation.